I've been asked to come in today to talk about the financial risks in exporting. This is not a solution for everybody. This is about an awareness, knowing what risks potentially you might face when you're looking at exporting, and pointing out where I can the potential solutions out there in the marketplace for you so that you know where to go and who to speak to. The things that I'm actually going to cover are the methods of payment. The most critical part of any business, whether you're actually exporting or not, is making sure you get paid. Without that, you're not going to be in business very long. So we're going to run through the 4 methods of getting paid so that you know exactly when you're actually dealing with overseas what your options are. We're going to discuss very, very high level Incoterms. Again, it's about awareness, making sure you know when something appears on an order that comes in from overseas, what it actually means, or that it has a meaning, that you need to understand that and the implications of that. I'm going to look at a very high level at foreign exchange risk and really why you should be doing something about that rather than potentially just ignoring it. So let's look at the methods of payment. Starting at the top there, for an exporter there, if you're going to get paid in advance, that's utopia. That's where you really want to be. Get your money up front, absolutely no risk to you. There is the potential that if the order's of a size which is sufficient, that your buyer overseas might ask you for an advance payment guarantee. So they pay the money up front. They might want the guarantee that if you fail to deliver, they'll get their money back. With a bank, that will require a line of credit. And it might be, if you're a small business particularly, that they want to have that cash covered. There is a possibility for the government to actually help you through UK Export Finance. I don't intend to go through that in this presentation, but if anyone wants to know anything about that, then let me know. So just be aware that if you do ask for money up front and they say yes, but they ask you for a guarantee, that potentially could tie that cash up. So if it's needed for working capital, you need to think about how you might get that released. But if you think about getting your money up front as an exporter, what's the position that your buyer overseas is actually facing? He's effectively trading you at the bottom end of that list on open account. So he is taking 100% of the risk. As an importer, you would want open account trading if you were buying goods in, and you'd want some credit terms attached to it. You'd want the chance to inspect the goods that are coming in. You'd want the chance to potentially sell them and collect the money in before you had to pay them. That will be exactly the same position as your buyer will be in. That's what he will actually want. So you can see you're at the 2 ends of the scale. You want advance payment. These guys want open account trading. In the middle, you've got 2 options around how you can manage that export risk. And there are only these 4 methods of payment. Letters of credit. I'm not going to go through the detailed letter of credit because you'd be asleep before we even started. But basically, if you were to be offered a letter of credit as a form of payment, you are receiving a form of guarantee that, provided you provide certain documentation stipulated under that letter of credit, that you will get a payment from the bank of your buyer. So it's a promise to pay provided you present the right documentation. There are all sorts of risks within that which you need to get expert advice on. You could be asked for documentation that you can't possibly provide. The underlying terms of the contract will dictate that there might be things within the contract that you can't deliver under the letter of credit. You can't 100% deliver what they're asking for. And if there are any discrepancies, any things that cannot be done, that promise of payment goes away and you're effectively on open account trading. So do take specialist advice. If you're offered a letter of credit in terms of payment, then you could talk to your bank and see what level of support they can offer you. But there are providers in the marketplace who are experts in this field who will handhold you, will guide you through what terms you should be looking for and what the appropriate terms might be for you, and even provide training for you if that's what you actually want, if you think it's going to be a regular occurrence. So letters of credit, that's the next most secure area for you, because provided you can deliver the documentation relating to that shipment of goods or services, you will get paid. Documentary collections or bills for collection, this is a banking term, which basically the bank acts as a post box. You provide the documents that relate to your shipment of goods. The bank will then post those on to the bank of your buyer, who, when the goods arrive, or in advance of that, if that's what you've agreed, will go to the bank to collect those documents. He will then either agree to pay at that point or agree to pay at a future point in time in accordance with your contract. And at the point of payment, that money gets sent back via your bank to you. So basically, the control of the documents relating to that transfer of goods is controlled by you through the banking system. That doesn't mean that the buyer has to take the documents. It doesn't mean he has to take delivery of the goods, and there is still a risk that he refuses to pay or can't pay. It means you've still got your goods, but they could be on a dockside somewhere in a far-off country. So potentially you have that risk of getting those goods back, or the cost of getting those goods back, which may or may not be feasible depending on your margins. However, at least you're not actually giving your goods away and never getting paid. So it's a middle ground, if you like, between open account trading and getting your money up front, and with the documentary credits being slightly more complex and involved and probably slightly more costly, although much of the cost should be borne by the buyer. Surrounding all of that, if you're doing anything which relates to documentary collections where you have that risk of non-payment if you give credit, or you do have to deal on open account terms where you're offering a credit period, then you should be looking at protecting your risk of non-payment by trade credit insurance. Now, there is a very active credit insurance market in the UK. It's recovered from the financial crisis now to delivering to many of the major countries, and that's where you should start your search through a trade credit insurance broker. There is a facility for UK government to support should the trade credit insurance broker either not be able to find you that cover because it's a market they've got no appetite for, or where they can't provide you sufficient cover to cover the total of your risk. Again, that's UK Export Finance, and I can provide you details after the presentation if you wish. So those are four, and the only four methods of payment you actually have. And again, you should start your position with, can I have my money up front? And if they do that up front and don't require a guarantee, then you're in a pretty good and strong position. I want to talk briefly about Incoterms and explain what they are and how they work and what risks they actually protect you against. Incoterms is a mnemonic which applies to an internationally set of agreed and accepted contract terms. They're agreed by the International Chambers of Commerce, and they are periodically updated. The latest version is the 2010 version. So what do they tell you? Well, most international freight journeys, and these relate specifically when you're actually moving goods across to other markets, are actually a sequence of small movements or processes. If you think about a typical movement of goods, your business premises, you take them to the factory gate, they're loaded onto a truck, they're taken by truck to a port. They're unloaded off that port and potentially containerized at that point. Containers on the dockside. Containers then lifted onto a ship. The ship moves from port A to port B, unloaded at the other end, loaded onto a truck, and then potentially driven 300 miles into Indonesia to their final destination. So all of these little elements of the journey all have a cost. And each of these costs must be paid either directly or indirectly, either by the buyer or the seller. And these terms are set up to tell you who carries the risk of the goods at any point in that transport and potentially who pays the costs of each of those areas. Now, these terms may well appear on an order from an overseas buyer. They may actually appear, or should appear, certainly when you issue a quote, so that all parties know exactly what it is you're agreeing to be responsible for and who's shipping for what. So, when should they be used? When you provide a quote. If there's an international transport movement involved, then there should be a quote confirming who's going to be responsible for paying for certain things. If you acknowledge an order that comes in without those terms on it, ensure those terms go on your acknowledgement of that order and on all your sales invoices or contractual documentation. So what do these terms actually look like? Here are a couple of examples of what they might look like and where they might fit in the process. Again, these are actually listed here in responsibility order from an exporter's perspective. So for an exporter, if you can agree that you're going to ship X works from Birmingham, if that's your base, That is the least cost and the least responsibility for you, because effectively the buyer takes responsibility from your factory gate for everything. At the other end of the scale, you've got delivered duty paid. That means on that transaction I explained to you, picking up from your factory gates and delivering 300 miles into the middle of Indonesia, every single bit of responsibility for the cost and the risk on those goods is yours from start through to the end, including paying the import duty that might be payable on taking those goods into the country you're going to. So you need to understand, if you're being asked to quote a delivery duty paid price, exactly what the constituent parts on there. Basically, there are 11 different Incoterms, and here are 4 of them. Basically, the X works, the E terms are where the seller makes the goods available to a buyer at your own premises. The F terms, of which free alongside ship is one of them, the seller delivers the goods to a carrier appointed by the buyer. Costs, insurance and freight is one of the C terms, where the seller arranges and pays for carriage to a named destination. And then you've got the delivered D terms, which means that you take through the costs to a named place of delivery or a destination. So an awful lot to take in there. Now, and this presentation isn't meant to be frightening you. It's about making yourself aware of what you need to be thinking about and making sure that when you see this sort of thing, or if you don't see it, you ensure it's included in your contract terms, because these are quite important. There is an internationally agreed arbitration route through this, and the user of these terms usually finds themselves actually in a stronger position. And so if you don't understand them, and later find that you have committed to something you haven't, then you're not going to get very far in terms of fighting your case. That's a link for the latest version. I would recommend that you write that down. I think there's going to be a copy of the presentation actually sent round to exhibitors later. I think if you're on the list, we'll make sure you actually get one sent out to you. That's all I intend to do around Incoterms. I say it's quite complex, and if you're regularly exporting and you need to understand how this actually works, certainly Chambers of Commerce will do and bring in trainers, and UKTI certainly through their masterclasses will provide trainers to do that, or there are private sector solutions and people actually out there who will actually handhold you through this and provide on-the-spot training to you and your whole of your export teams if that's what you need to do. But as a part of exporting, you do need to have a really good, strong understanding of this. And finally, I'm going to talk briefly about foreign exchange risk. And the first point I put on there, well, why bother, is really just because there is an attitude amongst some businesses that, well, if I actually invoice this in sterling and I get paid in sterling, I haven't got any foreign exchange risk, so why do I need to bother about it? And absolutely right. But again, whenever there's a strong position for you to be in, that puts the buyer in exactly the opposite position, because they have all of the exchange risk. If they've got to find the sterling to pay you for your exports, then they've got that risk of exchanging that currency. Now, okay, so one of you's got to take it. Does it really matter which one? That very much depends on whether you've got a product or a service which is absolutely unique and they have to have. If you're in that unique position, then fine, you can probably dictate those terms. But if you're in competition, and you're dealing with competition from somewhere in Europe or somewhere in Asia, and they are prepared to offer terms in the local currency of the buyer, and you've got a significantly similar product, the chances are they will take the easier option and take the one with no risk. So hence the reason why you should think about it, you should bother, you should understand what opportunity you might be passing by not actually taking that step and looking at the risks. So what are the risks? Well, clearly, if you agree a price with a buyer overseas, and let's say you're selling in dollars and it's $1,000 you're going to get paid, you've got to go out and you've got to buy the materials to make your product. You've got to go through a manufacturing process. You've got to get the goods on a ship and ship them out to the buyer. Potentially, you're going to have to allow terms of trade as well. So let's say you add 30 days onto that. Potentially, from the date you agree that price to the date you actually receive your money, could be 30 days, could be 60 days, could be 90 days. Depends how generous you are on your credit terms. Well, if that is the case, an exchange rate can actually move significantly in that period of time. They can move significantly overnight. And what you have to understand is that the drivers of the foreign exchange markets are not the businesses like you who are doing trading. They are people who are playing the markets. And I don't know exactly what the percentage number is, but it's quite frightening about how much of the total trade transactions are actually driven by market traders and not by people who actually need to buy and sell currency. So it's not really in your interest to be gambling like most of those people are. You really do need to make sure that you have got your price protected and your profit protected. So the risks of exchange rate movement are significant. A 5 or 10% movement in exchange rates can seriously affect your profit. If it moves in your favour, it can be an absolute bonus time. You get an extra 5 or 10% on top of what you thought you were going to get, that's great. But are you in a position to take that risk? Are you in a position to take that gamble? And all I would urge you to do when you're looking at foreign exchanges is to make a conscious decision about what you're doing. Don't just ignore it. If you decide that you're going to take the risk, fine. If it's a decision you've made, then you know what those risks are and you're prepared to take the consequences. But please just don't ignore it as being something that'll never happen to me. So what can you actually do? Well, the first thing you can do, which is the best solution for you, is if you're actually buying in from overseas to actually manufacture your product to ship out again, or you're buying in services from overseas, if you can trade in the same currency, then operate through a foreign currency account. That creates what is a natural hedge. So if you're buying in your product from Europe and you're paying in euros and you're receiving euros on a sale, then don't convert. Just convert the profit element when you need to cover UK overhead. So you're actually reducing your risk. But if you're not in that lucky position, then what you need to do is to take some advice and some guidance around what you can do. If you put yourself in a position where you were importing and you were buying now and you had to pay out that $1,000 in a month's time, there's a couple of things you could do. You could wait for a month and buy it in a month's time and not know what that exchange rate is, which means that you don't really know whether the price you've agreed to pay is the same price effectively. Or you could buy the currency now, so you've got it, you're sitting on it, so you know the price because you bought it, you've agreed your price overseas, so you've protected your margin. You can do exactly the same thing if you're receiving currency. You can actually go to your bank or a foreign exchange trader and buy that currency in advance of when you need it and agree the price now. So you're protecting your margin. You're not going to expose yourself to buying what the term is spot at the point you need to buy it. So you're buying now and you know exactly what that price is going to be. And that, I think, is the critical thing to do, is to know what that risk is to you and make sure you're protected. For a smaller exporter, those are probably the only options you've got. Either go to the market and buy it when you need it, or buy or sell in advance to ensure you know what that price is. Other options which are available to the larger businesses include sort of some element of taking some upside potential as well as a downside, because what you do lose is the potential for that big bonus if the rate moves in your favour. But if you're in the business of making something and selling it, you're not in the business of taking risk on foreign exchange. So avoid that at all costs. That is not what you're there to do. You're not a risk taker. So I have referred to UK Export Finance a couple of times during the course of the presentation. I am the UK Export Finance West Midlands Regional Representative for Export Finance. We do provide financial solutions through the government, working with the banks to help with working capital and bonds and guarantees. And we also, as I mentioned earlier, can help provide some solutions around export credit insurance where there are no solutions in the private sector market. There's an awful lot more detail to it than just that. But principally the role is also here to provide a free and impartial advisory service from my perspective to West Midlands exporters and my colleagues around the UK to their respective markets around where to find solutions, what solutions to find, and signpost you to people in the marketplace that can actually help you to cover your risks off. So if anyone has any questions around that or around the presentation, either the opportunity to do that now or to catch me on a one-to-one basis after we've finished. So thank you for your time and attention.